Hey guys, Brent Richardson here. I hope you'll join me today as we walk and talk about the Bank of Canada's decision to hold the overnight interest rate at 2.75%. So that wasn't a big surprise, the rate hold. There was about a 75, even an 80% chance of this happening going into the decision. But what we're more interested in is the decision making behind this rate hold. So we're going to talk about that. And unfortunately, it's not a pretty situation. There are two main points considered by the Bank of Canada. One being inflation and concerns about inflation, and the other being deterioration in Canada's economy. And so both of these 2 points, they're kind of playing off each other. We're going to talk a little bit about each of these points and how it came to affect the decision. So point number one regarding inflation. So inflation hasn't been quite rearing up, but it has been a concern over the last few months as we go into this new world of trade and as American trade policy affects Canada. This hasn't even taken its effect yet. And just the anticipation of trade imbalance between the US and Canada is leading to higher inflation. It's kind of an ominous pre-inflationary situation. So inflation means deterioration of the Canadian dollar, and it's the Bank of Canada's number one focus is to reduce inflation. The target range is between 1% and 3%. However, they like to remain closer to 2% or even 1%. They like to really have it under control. That's their overriding mandate at the Bank of Canada. And so when we're going into this period, which could very well be inflationary as a result, again, of trade imbalances and tariffs, prices are very likely to increase. Don't know how or when this is going to play out, but it looks pretty certain to play out. So the central bank is keeping a close eye on that, being their number one mandate. The second point is economic deterioration. We're talking about employment. We're talking about job losses. We're talking about economic growth or a lack thereof. So there is a close second for the Bank of Canada to manage as much as possible through their interest rate economic growth. And so what they're looking at is, do we lower rates to help boost growth, or do we hold them to help ensure that inflation is kept in line as much as possible? And so today they're saying we can't decide. Both are bad. If we cut rates too early and inflation takes off prematurely, well, that's a deterioration of our dollar. If we hold rates, well, the economy can deteriorate. It's likely to, unfortunately continue deteriorating. However, the central bank can always cut rates in the future if this is what's needed to help boost the economy. And likely this is what will be needed. Even though inflation is looking like it will be an ongoing concern, probably we're going to see the effects of a deteriorating economy happen sooner. So it's a matter of timing more than a question of, if. At least at this point, given the kind of data we're seeing, given the kind of political messaging, we're still seeing the uncertainty and instability there. But I think there is some certainty surrounding what's going to happen. And I think even the Bank of Canada, in the press release today, made that fairly clear that they do see economic situation slowing over the coming months, going into the summer and into the fall. And so likely what we're going to see are rate cuts. I think we're going to see a cut in July and then again in September. Now, it's possible they hold off, that the central bank holds off until September for the first cut. That's really inflation dependent, but I think they'll probably do it in July and then again in September, as opposed to, as I say, September, October, August being a month off from the meetings. And so we'll probably see 2 cuts in 2025, potentially 3, although the data currently doesn't support 3 cuts. It could happen. That would bring variable rates down by 0.75%. And we could see it hold there. It really depends on the magnitude of economic deterioration and how trade talks progress over the coming months. So even though there's some, fairly good certainty of what's to come, there's hope that things won't unravel economically, that jobs won't be lost. Right now, it's not looking great, but again, we want to be cautiously optimistic that, what's in the interest of the US and Canada are the same, vice versa. Inflation is likely to show more and more towards the end of 25 and into 26. So even though we might see cuts soon, inflation, again, given protectionism, given the higher cost of production, given limited input supply to build new goods and products, that's only going to gain a momentum, even with this tariff pause that we're seeing with China, and just the anticipation and the hostility. It's going to continue building inflationary momentum. So I don't want to call a rate hike at this point. I think it's very premature, but I think there's going to be a certain limit to how far we'll see rates drop over the coming months. So that's the main point for today. It's an unfortunate situation where, we have to make a decision, or the central bank has to make a decision what to sacrifice. Do they sacrifice the economy short term, or do they sacrifice the value of our dollar? We're just going to have to wait and see how this plays out. But I'll be here looking to report and looking to comment how things progress. I invite you to comment below, and thank you so much for watching. Have a great day.